Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. Every week we meet here at the same place at the Foundation for the Study of Cycles, Cycles TV. The topic for today is about long-term US Treasury yields. 30 years. That's what I want to align to you today. So we will have a look on the long-term 30 years US Treasury yield, not the bonds. So you know this is inverse correlated. We will look at the original 30 years US Treasury yields. We want to get a clue on what's maybe ahead on the US Treasury long-term perspective, and if we get a clue on that cyclic behavior, that might help us also to put this on the stock market. As you know, these are correlated in some way or the other. So that's the purpose for today. We will analyze weekly cycles on the US Treasury, and we will analyze daily cycles on the US Treasury. So that's what I have planned for today. I will for sure take your questions live at the end of the session. So on the first 20 minutes, I will roll out the cycle analysis on the US Treasury. So let's directly jump into it. Just up front, this is education. We are analyzing cycles for the purpose of time-based cycle analysis. I'm just using real asset data for sure. This is by no means any recommendation. This is no financial advice. This is pure cycle analysis to understand how to derive cycles of different assets. All right, so let's start that way with a special perspective on the cycles, and I will also introduce not a new, but a feature which is there for a long time, which might help you. So what we see on the screen here is the daily 30 years US Treasury up to the latest point. So this is the current data, and we go back into 2009, which means in this chart here I'm starting with a lot of data, which is not the standard procedure I would recommend to start. But for the treasuries, it's always interesting to see, and this is the point when I would recommend to use very long data as an historic analysis. First, if you want to get a clue, what are the key cycles in the data set from an historical analysis, not looking into the current phase and projection into the future, just to understand what are the most important cycles. Then use more data for sure. It's always useful, but only for that purpose. So let's get back to the analysis chart here. So that's why I start with these 15 years of daily data. Everything is used, and you see here at the bottom, this is the the spectrum which gets out of that. So this is not a usable spectrum to do a projection, but it gives us a kind of clue on prominent cycles. So we have a lot of clutter here in the short-term cycles, and then if it comes to some longer-term daily cycles, we see some cycles are standing out here, and also our AI engine is clearly preferring one long-term, mainly, I mean, these are trading days, so these are not calendar days, need to be a little bit possible, but close to a yearly cycle here, 356 calendar days, which is picked based on different reasonings, but we also see this stands out here. So we know from a long-term perspective, this is an interesting cycle to pick. For the other ones, to be honest, there is no clear rule we can identify which one to pick here from the other ones. But we have one dominant cycle. So now we can shorten the time frame for the analysis, as we are more interested what's the cyclic situation today, not on average for the past 15 years. And what I want to look for is this long-term 356 trading days cycle, which is the dominant cycle on the long-term perspective, still dominant, still active if we just use the current past of the data. So therefore, I will now shorten the amount of data we take into consideration. And for example, I mean, you know the basic rule of thumb, which is multiply the longest cycle you want to detect with 3 so that you get 3 full repetitions in a possible analysis, and that's the minimum length of data you should use. So if you want to detect 300 to 400 cycles up to a length of 300 to 400, you should use around 1,800 to 1,000 data points for your analysis. That's the basic starting point. If you want to further fine-tune your amount of data you put in, always try to pick the starting point for your analysis and a very important bottom or top in the data set. So this is, for example, what we can identify here in February 2020, because that's more or less the point when this up leg, which is now intact for the past 4 years, started at this point in time. And these points in time are key points time-wise when the underlying rhythm changed. So picking that as a starting point for the cycle analysis is always interesting. So let me first pick that one here. So somewhere here, it's not as important to have the specific date, but as you see here now, the dark blue indicates the data which has been used. And you can also see that the amount of data we are putting in is now around 1,000 bars. So I would count this is a kind of optimum. We have found a major turning point in the underlying asset. It has around 1,000 data points now for the analysis, which is quite perfect to get the current cycle. And if I mean the current cycle, it's always not only about length. More important is then often also the phase. So the phasing, where is that cycle? Detecting the length is one part of the story. But being able to detect the current phase is often much more important than just having a clue about the length. So, said that, let's now look into the spectrum with using this shortened amount, and now it's more clear what cycles to look out for. So, and that's why I started that analysis maybe the other way around. You see that this long-term cycle around 318, 320, before it was 350, but I won't count this the same nominal cycle, is again still valid here. It's just in that case for this shortened amount not picked as the core dominant cycle because it's missing some features here. And if you know how it works in general, this is too flat from a plateau in the spectrum. This peak is not as sharp as we wanted to have. Therefore, just looking at the short amount of historical, it's not a perfect peak, but it's still green. So the Bartel score you see here with 93 is more or less the highest Bartel score we could even think about. The amplitude and at least the strength is in the same ballpark as the second picked cycle here. So from just looking at strength and Bartels, this and amplitude, so these three values are even better for 318 than 209. However, the 209, if we look into the spectrum, has a better shape in the spectrum. But here now comes into play the reasoning, I would say, if we have from a long-term historical analysis for the past 15 years and the knowledge that the 340 cycle clearly was standing out and we still have it here, let's start with that longer term cycle first, and then let's walk forward from here. So just the last up leg from 2020, we could see this sub-rhythm in that cycle if you have a detrended perspective now on this upswing. So ignore the underlying uptrend we have since then. What we're analyzing is now the cycles around this trend, which I'm just trying to bring in here. So, and what I tried to circle in red is exactly the cycle which has been detected and overlaid here in this purple color. We just use detrended analysis for that amount of data. So I think it helps you a little bit also to understand what the cycle analyzer is doing here. We take out the trend in the in-sample data we are using. But you see, it makes a fairly good job in detecting the underlying rhythm in this running long-term uptrend here. So, and by knowing now these two facts, so first we know it is and was a long-term valid cycle. We now are able to zoom in, use the current phase of that cycle. So where it is today, not the average cycle, not the average cycle length. So currently it's around 318 from the length. So the cycle is, the length is for sure varying. And we use today's phase. Phase means where are we in the status here? And the phase here clearly shows we are close to a bottom of that cycle. So now the conclusion of the daily long-term cycle is that we might have a short period of 4 to 5 weeks maybe where we could see decreasing US Treasury yields, but in general the second half of 2024 should see rising US Treasury yields based on that cycle. So the daily, most important daily long-term cycle indicates we might be close to an interim bottom. So maybe another interim bottom. And then we are heading upward into another upward cycle with higher 30 years US Treasury yields ahead of us. That's the daily for sure. We also now need to switch the time frame. So now let's analyze the weekly series and let's see if we find similar or disagreeing cyclic clues on the weekly time series. So therefore, switching now to the weekly data set. So we are still using the same asset. So we are analyzing 30 years US Treasury yield prices, which has this from a long weekly perspective, the downward trend seems to have ended here 2020, and we are in this upswing spiral here. And let's now see what the long-term cycles suggest here. By the way, this is the kind of standard analysis starting with the around 880, 900 bars of historical data, so which gives us a kind of clue about the current active cycles. And here what's really interesting, we have two cycles which are marked or pre-selected or pre-proposed by our cycle copilot, which shows us there's a cycle of 74 weeks and 66 weeks from a weekly perspective, so that there are two cycles around 60 to 70 weeks, which, and that's the reason I wanted to just highlight that purpose. Just think back about the daily cycle we just talked about and have detected. That was a cycle about 350, so long-term 350 trading days. If you convert 350 trading days into weeks, so you arrive at around 60 to 70 weeks. So the 66 and 74 weeks cycle we are seeing here as key dominant long-term cycles on a weekly time frame seem to be in alignment from the length with what we have also identified as long-term cycle on the daily chart. We don't know how the phasing and the situation of those cycles is, but just if we have a relationship here in the cycle length. So that's set up front, and you clearly see these cycles stand out here as short-term cycles in this case, and that's also not often the situation. We have two cycles here, and they are almost perfect from their shape in the spectrum. Clear peaks, left and right shoulder going down. We have a triangle, strong strength, Both are green with good Barthel score, so which is quite perfect. From a long-term weekly perspective, this also comes into account, but we should start with those here as they are also selected. And as we know, they fall into a similar ballpark as the daily cycles. So enough talk on the analysis. Let's now put these cycles on our chart here. So now we see the overlay of which I've started this 74-week cycle here. We could zoom in a little bit to just cross-check if it's also matching with the key swings of the US yield prices. And it does nicely correlate to the major turning points here. So as you know, we are not interested in the absolute price swings. We are interested in timing, so that these situations here correspond to when the major trend changes, which you see here is aligned time-wise. It's not about price-wise, the alignment. We always look into the timing situation, not the price movement here. So we use this as a timing indicator. Okay, so that said, now looking into that situation. So from that long-term weekly view, this 74-week cycle has a similar situation. So it's in the mid of its down leg. So still maybe some time to go until we might come to a bottom. But then for the second half, or at least the last quarter, so somewhere in summer, it's turning and even turning into early 2025, we could see increasing US Treasury yields again from that weekly cycle. But there have been two cycles, so we also need to cross-check the other cycle, which is in that situation. And here we see this is the 66-week cycle, which I've activated here. Similar situation, but here we are now close to the bottom. So those two cycles have just a small deviation in their bottoming phase, but the bottom, if you combine both, is this summer. So that's why I think it's interesting. One is bottoming more early. So what's that, in July? So in 4 weeks. That's more or less similar to the daily. The longer weekly long-term cycle is bottoming late summer. So somewhere August, September. So but at least both confirm that after summer, late second half this year, also from a long-term weekly perspective, the US long-term Treasury yields should rise again. And we can now build a composite of those both cycles. And let's see what a composite looks like. So that's what I said. It's more a mix of both. So it's in the middle. So this is now August where the bottom is. And if we zoom out a little bit, we can also see how the composite model looks like. And by the way, this is a nice situation. This happens when you add two cycles with a similar length. So as you know, 74, 66, it is kind of same nominal cycle, but you see there are periods when they cancel out each other, yeah, which is here, and you see also that the price swings in the underlying US Treasury yields has been more or less sideways situation, or at least a period where we had much smaller swings in the extremes of bottoms and tops. So from 2015 to 2018, there was a very small range for the US Treasury yields, and that was in alignment with the more or less canceling out of these two cycles, which gave them more flat period. And it's also interesting when these cycle phases have been in alignment, so they are just slightly delayed. So over time, you will have timing periods when they cancel it out, and you have also windows in time when they just add up. So they accelerate the movements to the upside and to the downside. And this was the situation. Let's clean up here during this period here, when you see these big swings, and this is the addition of two cycles which are in alignment. you see also these huge swings in the underlying treasury yields, and these huge swings did not appear in that period here. So it's kind of very interesting to see the interaction of these two longer term cycles, while their length is still similar. So you can both call them the 350-day cycle, but on a weekly chart we see two which stack up on each other, and this will result in period when that cycle is more quiet, or you would not see that cycle on the chart again. So it looks like the cycle disappeared, but it did not disappear. It's just the combination of two cycles. And on the other hand, you can also identify the periods in time when these cycles really accelerate the price moves or the volatility then in the asset. And we are currently in that period. So let's now have a closer look to where we are in that composite cycle. I would call we are still in this high range of that cycle, which goes into early 2025. And then we are after 2025, we are then entering this flattening period again. So, but at least we are in the here and now. So let's look in the closer future here. So we could expect here now, or we are close to finishing the down leg, which is coming from October last year. And this down move, where we had the high in around 5% of the US Treasury, 30 years, we are now close to an end of the down move, but we should then expect another upswing here into early 2025. So summing that up, and this is why we are here, we have the 350 trading day cycle in the US Treasury prices, which is indicating close to a bottom, and then higher yield prices ahead of us in the second half of 2024. This is confirmed by two long-term weekly cycles, which still show us we're in a very volatile pricing situation, which also agrees that later 2024 we should expect higher US 30 years yield prices ahead of us. So that's it. That's the conclusion for today on the US Treasuries. And I think you know what this means for the stock market. So we could expect pressure. We could expect more stress than coming into the stock markets if we see the yields, long-term yields, moving up again later that year. As said, this is pure cycle analysis. This is not an analysis of the economic conditions, of inflation, of how the US economy is in shape. This is a pure time cycle analysis on the 30 years US Treasury. It does mean nothing. Maybe it works that way, but we want to learn if cycle analysis can help us using this timing information now for our decision-making process, technical analysis, or whatever our expertise is now in that area. That's why we are here presented. So that's the summary. So we are done with the main part of that video. As always, I think you have a holiday in the US, so we don't have a huge audience today live here, but Dan, Adel, Yosu, Andrea, thanks for being here again. I see you in the chat section already. And if you want to discuss something, throw in your questions now. At least I see already a first question showing up, which I want to bring to your attention. Dan is raising the question, increasing long-term yield means that the inverted yield curve is probably normalizing again. Yes, so the inverted yield curve is another interesting situation we are still in for a long time already. And yes, it could normalize. But by the way, this is an interesting fact that we know that inverted yield curves are often a precursor to possible economic hard times ahead of us. It's a leading indicator, especially at the point when it starts to normalize again. So when the inverted yield curve comes back to their normal situation, that's the point in time when the question is how the economic situation will be. So this could be the case in the second half of this year or later 2024, which could then be another indication. It could indicate some trouble for the US economy and the stock market itself. Yeah, and Goldorak, exactly, that's the good follow-up question. So you should do the same analysis now on the 2-year or the shorter term yields to see if this will then solve the inverted yield curve if it inverts. So we should do the same analysis. I think on the short term yield prices, it's more an architectural thing about how this is managed by the Fed and what the short-term rates are. So I think the long-term you cannot really manage or artificially manage. The short-term can be constructed or artificially managed or influenced in that way. So that's why I did not analyze the short-term. But Goldorak, yes, please, I would now leave this to you. You have access to the same tools, and this would be the next step. I would propose to do so. Yeah, I mean, I'm not here to do any economic interpretation, but Adil, looks like. So yes, looks like that could be an indication that interest rates coming down might not be the case later that year. So we will see. But you are on the right track to draw that conclusion. And that's why I say cycles have no information about these economic indicators like interest rates, economy, and inflation data. So it's a pure time-based cycle, but it would be exactly as you said. So let's see if there's any meaningful value. We need to revisit later this year to find out. Yeah, Goldorak, that's exactly, I hope I tried to bring this across. That's exactly what I wanted to say. So the short term could be influenced by Fed and some monetary architectural patterns they could lay out. The long term could not be architectured in that way. So that's why I used here for the analysis the 30 years, because these cycles are not coming from the Fed and they cannot fight it. So that's why the long-term cycles are interesting. Yeah, but now this is the next step. As said, I think now the interpretation is now out there, what that means. So maybe short term or for the next weeks ahead, short term. Yes, higher for some longer, but then when we see increasing yield prices, we need to be careful here. And this lines up with the US elections in November. So from a cyclic perspective, and I highlighted that also on the stock market. So from a cyclic perspective in general, I see a change late this year. Pure cycles perspective, I see similar long-term cycles changing into a downward phase for the stock markets latest November. I've shown you here today that there's also a change ahead or increasing yield prices into US elections, which means a lot of trouble for politicians ahead at that point in time, which then need to deal with that. Okay, thanks for the topic. Maybe Abaka, a special question related to service. How can I get the analyst status? So in short, we have 2 subscription levels at the foundation, the basic and the analyst, and you can upgrade your subscription on your own on our cycles.org homepage. So just head out and need to upgrade your subscription to Analyst. Then you get that status. If you don't know how to upgrade, that's maybe a question you should raise. But everything should be documented on the cycles.org website. Just search for these 2 subscriptions which are available. All right, so then thanks for joining me today. I hope you enjoy a nice holiday if you are in the US or the UK, so you enjoy your day off. Otherwise, I would be happy if you like and if you would subscribe to that channel. That's always welcome to give us a chance to grow. And otherwise, for sure, please stay with me next week, same place, same time, Cycles TV, Foundation for the Study of Cycles. Have a nice week. See you there. Thanks for joining me.